Great. Good morning, everybody. I'm Mark Hoeing. Torsten, thanks very much. Terrific run through the macro. And as he said, for the first time in a long time, macro people are having a field day. There's a lot to talk about from a macro perspective over the last 5 years. We really appreciate that. What we're going to do on this panel is shift gears to the micro. There's been a lot said about what's going on in private equity and venture capital. We have some real experts here on the panel to go through that. But maybe just quickly, by way of background, I'm Mark Hoeing. I'm with Common Fund. I lead the CF private equity business, which is the business inside Common Fund that invests as a limited partner into venture capital and private equity funds. We also execute on direct co-investments and secondary transactions within that profile. Common Fund's history, we're close to a 60-year-old company. We are really one of the original outsourced CIO businesses. We have about 150 clients. We manage 100% of their capital in an outsourced CIO model. And through that, about 40 years ago, CF Private Equity was set up as a wholly owned sub to build a team. I lead that team of 60 people. Again, all we do is invest in private markets. And to set the scene for private equity, what have we been experiencing for the last 3 to 5 years? It's been a shift, right? We've had a declining fundraising environment in private equity for the last 2 years, which is the first time in a long time, probably in the careers of all these folks, where we've seen a decline in fundraising. Exits went down in private equity, as we all know. Really, the interest rate shift that started in 21, 22, 23 put a lot of pressure on private equity. And then we took a breather in the IPO markets, right? We had several years of zero IPOs. That did reopen in 2025. I think we're in a little bit of a pause mode here with the macro backdrop in 26, but as we all know, there are several venture-backed companies that have incredible valuations behind them. We want to talk about some of that today, and most notably, SpaceX. Everybody's got their eyes on an IPO there at $1.5 trillion estimated valuation, which would be by far the largest kind of IPO that we've experienced as investors. And then, so maybe just to jump into it, our panelists have 3 different perspectives of private equity and venture capital. Joining me are Rick Heitzmann, who represents Georgetown. I didn't mention my Providence roots.
Who won last night?
Yeah, Providence, feeling the pain. I am a Providence College grad myself, as is my wife, who's in the room with us today. But to Rick, he's the co-founder of FirstMark Capital, and clearly you have the lead on the underdog story of the tournament, so look forward to having you rub that in. But as an early stage venture capitalist, Rick has been behind many of the most successful companies we've seen: Pinterest, Airbnb, Discord, Shopify, and others. He can talk a little bit about those companies. He's a founder of the firm, built his own operating company as well, so terrific background. Focused on early stage venture. To my left is Todd Cozzens. Todd is co-founder of Transformation Capital. It's a growth equity firm focused on digital healthcare. And Todd has spent over 30 years in healthcare, first as an operator, helped build a company that he sold, spent some time with Sequoia Capital and United Healthcare's Optum healthcare business, which for anybody in the healthcare industry knows, Optum is a global leader, certainly a U.S. leader in healthcare services and insurance over the years. So a lot of experience out of Todd and his firm, Common Fund, full disclosure, a big backer of Todd as well. And then we have Mario, and I should have said Marquette grad. So representing Marquette today, tough year. We'll be rebuilding with Providence. And then we've got Mario Masrieh, who really has a different angle on things. He spent a lot of years in the middle market, building middle market companies as an investor at a firm called Trivest, which is a market leader, and one of the longest standing private equity firms in the US. He's going to bring a perspective as both kind of investor and operator in middle market companies, which is certainly a different segment of the market. And Mario is a Villanova grad. Tough loss yesterday for sure. But maybe high hopes for an NCAA bid, regardless. So anyway, across the board, a good group. So why don't we spend the next kind of 90 seconds with each panelist kind of just walking us through the firm that you've helped build and kind of your biggest focus area in 2026. And Todd, maybe we could start with you.
Yeah, great. We're a 10-year-old firm.
We manage about $2.5 billion under 4 funds, 53 digital health companies. Digital health is a broad term, really covers healthcare tech, healthcare IT, health AI for healthcare, which is obviously the biggest growing part. We are former Bain and Sequoia partners that formed this fund. We've got healthcare knowledge. We've got founding company knowledge. We've got people in our investment team that have been former clinicians. We think the specialization is really important because healthcare is so complex. And we've looked at over 10,000 digital health companies since we started Fund 1. And so, as I tell my wife, I'm in the business of saying no. It's a really fast-growing, the fastest-growing market in both tech and healthcare, which is digital health, because of a lot of things which we'll talk about later in the conversation.
And priority 2026, what are you looking at today?
AI native companies with great founders, with great tech, with good pricing where we convince them, get preemptive, and convince them that they need more than just money, and they need more than just high valuations. And that's been our mantra. And then also DPI, which we have a very robust exit market other than you might think that is happening in other markets, which I can talk about later as well.
Great, thanks, Todd. Rick.
Hey, thank you very much. As was mentioned by Mark, I'm an entrepreneur, founded a business called First Advantage, grew it, took it public, and sold it for over $1 billion, and then formed a little over 20 years ago, FirstMark Capital here in New York. We do early and growth stage venture investing, really focused on both the consumer and enterprise capital efficient application market. So everything from commerce with things like Airbnb to SaaS applications with things like Shopify. We really focus on really getting deep with the entrepreneurs, having high conviction. We join the board despite taking minority investments, tend to be the lead investor. We know our markets really well, so we have deep focus and swim lanes, and we have a geographic bias to the New York area. We think this is a great area that's changed tremendously, both through the digital innovation in the last 20 years, as well as it's going to change tremendously by the disruption of artificial intelligence. So we're most excited about over 2026, exactly what I just said, the digital disruption of AI. Amazingly, I was also a venture capitalist in the 90s and saw what happened when the internet and digital disruption hit everything. And part of the reason we're in New York is there's more industry centered here. There's more Fortune 500 companies centered here. And we love big companies, big industries that experience massive change. We took advantage of that in the last cycle, and we see that same cycle coming as AI comes for industries now. So super excited about the future.
Thanks, Rick. Mario, where have you been focused? What are you focused on in 2026?
Absolutely. So while I love New York and started my career here, I'm a native Miamian. And so in the next winter, if you want to come down, come visit. But I started my career here, as I mentioned, Morgan Stanley. I was in consumer retail. Pre and post my MBA was at Gridiron Capital, and then moved home to Trivest. Trivest is a firm that focuses on founder family-owned businesses. So unlike Todd, who's specialized in healthcare, my specialty has always been just founders broadly from a partnership model. I left the firm about a month ago, and in the process of setting up my own firm, what I would say, and by the way, that will be a continuation, so a lot of experience in and around founders. What I would say from a focus perspective, beyond getting that off the ground, is going to be probably going back to the basics, so cash flows. As we look at the current macro backdrop, Thorsten's conversation earlier, AI, making sure we're being disciplined. The classic adjustments to EBITDA and valuations in these types of more volatile markets, just making sure we're understanding the durability and specifically around cash flows of the companies.
Got it, thanks. And putting really private equity in context, from an LP perspective at Common Fund, we sit on over 100 of our manager LPACs, so we get to see a lot of different flavors of what's happening in private equity. And I would sum it up and say, I think we all saw this correction coming. We saw so much capital pour into private equity in the last 10 years at a near zero interest rate environment. And we saw a lot of strategies really falter. And I would say large leveraged buyouts, mega cap buyouts in particular, and some of the pre-IPO momentum investments. Those are the two strategies that were the hardest hit. So when we look at capital pulling back, I think it's pulling back in those areas significantly. But in these three areas that these gentlemen kind of operate and work, we see real differentiation in terms of how investments are happening in private equity, and see a differential in return as we all kind of lick our wounds, I would say, in the industry generally, and prepare for what's next. It's frequently the vintages like these, where there's uncertainty and pullback, that turn out to be the most significant outperformers. It makes the job very difficult for all the CIOs in this room to predict kind of when these cycles turn, but when they do turn, you really do see outperformance. And so I wanted to dig in there and talk about the technology landscape, what's happening in technology. The word transformation is used in almost every segment these days: transformation, AI, enterprise software, healthcare, and then business transformation of family-owned companies, and the need to do that, which is really what Mario focuses on. Maybe you could talk just a minute about transformation with respect to your strategy and how you see it. Is transformation being embellished, or is it truly happening? And Rick, why don't we start with you?
Sure. Yeah, we excuse me. We use both transformation and disruption, and things getting thrown up in the air, and we love that. We love large industries changing. You know, we've invested with Todd in a company that's saying AI and how it's disrupting an industry, and how technology, which has never been available before for a certain industry or industry segments, changing everything. In the case of our co-investment with Todd, it's basically using AI to look at healthcare claims and, and mitigating fraud and waste in one of the biggest sectors in the world. So we're deep in healthcare and think about that, and we think it's a really great segment going forward. But we're seeing everything kind of being disrupted. If you look at legacy software companies and what's been called by CNBC the SaaS apocalypse, of just a tremendous bloodletting in the public markets for companies that have undifferentiated products that have not really evolved in the last 20 years. And so you're seeing those multiples shrink and those businesses be called into question. So we take a very, very deep look, and why we get deep into segments about what matters, what doesn't matter, what's being disrupted, and what's sustainable. We think AI is calling all of that into question. We've spent a massive amount of time with both people in industry as well as internally figuring out the mental models around that. So we feel good about, you know, certain areas of software that have systems of record and deep pools of data that have some sustainability if they have the ability to build and grow. And, you know, we just sold a company to Salesforce last week that's using AI to really enable the system of record and the workforce and data that Salesforce has. So we see a great path forward. But we also, like a lot of disruption, we're going to see some companies left behind, and really that's our job to kind of pick what are the companies that are going to be left behind, what are the technologies that are going to be able to evolve with the next generation of technology, namely AI, and how do we help them do that by what are these disruptive technologies that are the right technology at the right time to really get to that next level. And we think about it in all elements of, we call it the software stack of infrastructure technology, application technology, and the AI experience. Some companies like Anthropic are operating at all three of those areas, but really it's important to deeply understand them. And as you think more broadly, I think some of the babies have been thrown out with the bathwater in the public markets, and I think there's probably some companies that are still valued at billions of dollars that maybe have some more downwind to come.
Maybe picking up on transformation, Todd, you've had 30 years plus of history in and around healthcare. Why did you choose healthcare? What's transformation look like in your sector?
Well, I fell into healthcare, long story, but I was trying to win a gold medal in Olympics in sailing, and I needed a job, and I got a job with a healthcare company. That's how I got into it. But many years later, in companies that I built and sold and took public, et cetera, I was finally, after selling my last one to United Healthcare, I was asked to join Sequoia. Sequoia, was not a firm raising capital in healthcare when I was raising money for my companies, because they had dabbled in biotech in the 90s and didn't do well, which is very rare for them. And when the digital market started to boom, and this is what's happened here, is that, what I want to say, all due respect to our previous speaker, I don't care anything about that shit. Because healthcare is its own bubble its own universe, separate universe, whatever you want to call it, its own vacuum, its own bizarro world, in that it's $4.9 trillion of spend. We spend more on healthcare than the GDP of any country in the world except for China, and we waste $1.7 trillion. And that's on fraud, waste, and abuse. That's unnecessary procedures. Just the overhead and managing claims, you go in and get a prior authorization, and that gets turned down, and then you submit a claim, and that gets turned down, and all the back and forth. That's $350 billion of waste right there. That's the opportunity that we're going after. It was never automated before until about 2009 when we put electronic medical records in the hands of every doctor and hospital with free government money that came out of the stimulus package of that era. And so we had big software adoption during the years, and that was really where we got started with building this fund and this firm. But still sales cycles were long, a couple years, sales cycles, et cetera. And that's all changed now with AI. Healthcare is 30% of the world's data, and we only touch about 3% of it. Healthcare is adopting AI at twice the rate of other industries currently, and there's a huge transformation going on, and it's having an impact. And we're seeing buying decisions go down from years to months. We're seeing companies growing 2-3x what we saw 5 years ago. We're seeing them do with 1/3 of the cash, so we don't get worried about the debt markets or anything like that, because most of our companies are growing with primary capital and being extremely cash efficient. So there's a huge transformation going on. There's low-hanging fruit like revenue cycle. The company we invest in with FirstMark, and by the way, we think it's a great partnership with our healthcare knowledge. We want the deep tech knowledge of a tech firm, so partnering is a great formula that we're engaging upon now. But there is an immense opportunity, and we're only touching it. It'll be 20 years before healthcare is even remotely as automated as other industries.
We've seen huge pullback in cash flows for services in healthcare in the last 2 years, but what you're describing is a productivity enhancement opportunity in the underlying tech companies that are moving the needle for providers, insurance companies, et cetera.
Yeah, the dirty little secret underneath all of this is that 80% of health insurers and 80% of providers are not-for-profit. They can't hire great tech people. They don't offer equity. So they have to buy. They have to buy solutions. And then now the other side of the equation, the pricing, you'd think that would cause pricing, if you automated it, the pricing would come down. The pricing's regulated. So if you can take a services company and apply AI to them, the profitability and the growth is tremendous, and that's a real underlying opportunity in our market.
But we're also seeing, better quality of care, better access to care. So going back to, hey, the American GDP just for healthcare is the third largest GDP in the world, and that's a great step on Todd. We're seeing better, faster, cheaper from an end user perspective. So like the patient wins, the provider wins, and the payer wins. So it's really an amazing time.
Mario, you spend time in the middle market, mostly succession buyouts, mostly family-owned companies. What does the world of transformation look like from your lens?
Todd used a word a couple times, partnership or partnering, and I think it's a really important one. There's two things that are going on right now, partnering and I think a 15-year window, which I'll touch on. From the partnership perspective, AI is scary for some. It's the emergence of a new technology. And so when we look at founder-owned businesses, we ask ourselves, are they someone that is open to partnership? So there's a lot of investors in the room. Control or buyout is a common word. Using the control moniker's the false one for founders. You can't control people, you can guide them. And so that partnership model to me and to us is very important, where how can we help? What are you doing? The gentleman talked about how AI is making these services businesses much more efficient and enabling a better service to their end clients. We've seen it in a number of markets, professional services, for example, just the simple, even back end. There might be attorneys or former accountants in the room. Entering your billable hours is frankly not a productive use of time. So can even just AI technology enhance that? Then what are we doing? We're freeing people up to better serve the clients, and that's across the whole talent stack, from juniors up to the top. The other important, I think, window for all of us is kind of 15 years. So maybe for Rick, just the growth curve for some of his investments takes a while in that sense. You know, they've got to scale it to the point where an exit makes sense. Same thing in many ways for private equity and growth equity, where we have to consider the next investor and then the investor thereafter. That's kind of the window. And so is this founder, is this team capable of partnering and transforming over that period? And it's a harder lens to look at today. What we've noticed the best way to do it is the culture and the team set up for that open-mindedness, that partnership to properly think through that window. That's kind of how we've been approaching it.
Great. So I'd sum it up. The common denominator across the board is kind of low levered strategies. We're not using a lot of leverage to grow these businesses. We're focused on top line. We're focused on changing companies and the trajectory or the arc of a 10 to 15 year window. In our view, a common fund, that's the perfect equation for private equity. We always looked at leverage like, hey, it'll giveth, it'll taketh away, and it's whacked an entire set of vintages in buyouts. And so now we're living with the aftermath of that, and these strategies make sense. Rick, we've heard some people draw comparisons between today's AI environment and the dot-com bubble. You made reference, a little bit of reference to this, but maybe from your lens, having operated in kind of both segments as an owner-operator of companies, a builder of companies, and an investor, what's genuinely different this time versus what's the same?
It's a great question, and I was a VC in the 90s in that go time of the dot-com, for those who remember that, and then I operated through the post-September 11th dot-com crash that people thought the internet was a fad that was never not going to exist anymore. So it was the ups and the downs, and I think we're currently, as we saw earlier, very much on the ups in AI. What we saw in the really the digitization or the internet boom was there was a lot of infrastructure being built, and people weren't sure what applications were going to live on top of it. And so, there was companies that don't exist today that were really capital intensive. If you think about the Nortels, the cable and wireless, the infrastructures, people look like they've never heard of the companies, largely because they don't exist, because they were laying fiber, they were building switches and routers and building out the infrastructure. But what wound up happening now, 25 years later, amazingly, is that the application companies are the ones that are survivors and captured the value. Companies that we do know and love and use every day, the Amazons, the Googles, the Ubers, the Airbnbs of the world, is where value was captured because they were really providing value on top of it. What we're seeing today and where we think we are in the cycle today is that infrastructure is being built out. We talked a little bit about before, data centers being built out. Really a lot of CapEx being put in the ground, largely by the hyperscalers, to build out the switches, the routers, the chips, the data centers, the energy it takes to run this next generation of AI. And we're just in the early innings of having the application layer of AI being built out, the Vercels of the world, the Synthesias of the world, the Anthropic Claudes and OpenAIs of the world. So we think we're on this precipice. Largely the risk factor, which we've talked about, is how long does the CapEx boom last, and what does that mean for the capital-intensive infrastructure players, and then what happens when that stops lasting with the amount of debt being raised, circular deals, et cetera, that I don't want to go too much into, and then can we get escape velocity in the application companies? So we hate it, capital intensity. We actually kind of hate leverage too. No offense to my fellow panel members. We're Apollo. But what we really want to do is think about capital-efficient businesses that have, therefore lower downside, higher upside. If you think about, again, the Googles of the world, and we think we're at a point where that's starting to come into play. And I'm sure if you talk to, if you think about your usage, your family's usage, your friends' usage, plus or minus a generation, these new AI tools are being used, and we think we're just on the precipice of more broad adoption.
Got it. Maybe just switching gears to your lens, Todd, as it relates to artificial intelligence specifically, where are you seeing the use cases? Maybe some examples of companies that are changing the way businesses are operating.
Sure. The company that Rick's firm and my firm are partnering on, they're helping health insurance companies find out overcharges from hospitals, and there's a lot of overcharges from hospitals like sepsis and trying to get reimbursed for things they shouldn't be getting reimbursed for. On the other side, we just exited a company on the provider side that was helping providers get revenue that's due to them from payers. And there's, on the revenue cycle side, there is an arms race going on here on both sides, and I think the providers are a little bit ahead of the payers now, but the payers are starting to catch up with companies like Alafia that we followed the investment that these guys brought in. So revenue cycle, clinical decision, helping. We've got a company called Sword, which is virtual physical therapy, but now they're expanded into AI care across women's health, behavioral health, cardiometabolic health. They're really becoming an AI care company. And what they're doing is they're allowing caregivers to really practice at the top of their license. So yeah, they're going to eliminate some jobs. A lot of administrative jobs are going to be eliminated. But a therapist wants to not spend all their time on lower back pain. That can be easily handled by AI in most cases. They want to spend their time on brain trauma patients, et cetera. And that's what AI is really allowing us to get much more efficient care, much better decision making. So we're seeing it across the threshold. We're seeing the need to adopt AI and get digital is a more compelling notion we've ever seen before, and that's why these buying decisions, because these health plans have got to compete not just with their competing health plans in a different region, Blue Cross, competing with United. They've got to be able to negotiate with the people on the other side of the barrier, which is hospitals and doctors. And so if they're not adopting, they're going to be behind, they're going to lose.
Mario, you invest across multiple sectors. What does that look like from an AI adoption standpoint? Is there low-hanging fruit? Is there not? Are current owners and runners of companies hesitant to implement AI tools?
So I'm going to piggyback on a couple things and answer the question. Rick was talking about leverage in particular. Being a low-leverage investor is a very good value proposition in today's market. High leverage would not allow us to achieve growth and pivot as AI is becoming more prevalent and maybe seize opportunities. So I think low leverage today also, especially for control or buyout oriented firms, is a very important lever. And Todd was talking about some efficiencies within maybe a back office or an administrative function. We're seeing that as probably the low-hanging fruit that companies are starting with. There is a hesitancy, kind of as I was talking earlier. Some founders they're scared. They just don't understand it. But ultimately, we're seeing that administrative, operational end as the start, and then people are moving more to the top line, the revenue side, and maybe give some other examples for it. How even with service providers. So now a lot of our companies, if you think about private equity, this is one reason why I've spent a good amount of time in professional services. We are voluminous procurers of professional services. But with AI, there is now the conversation consistently, well, why am I paying you the same or more? Have you not automated this yet? And that's being pressed all along. So we're even helping companies think through that. Why are you paying the same when you might be able to get it more efficiently?
So to Torsten's point earlier, almost every company is thinking about how to implement strategies and pushing big vendors to bring a better AI game to the table and automate.
I would argue if you're not thinking about it, you're behind. And so you think about maybe the gentlemen here are more in the new company, the more new emergence. Private equity is more investing in the traditional businesses or the established ones. The companies in my market will succeed by having the close relationship already with their customers and leaning into the technology to better serve them. So they have to lean into being the best in class, the top end. They don't have to be there necessarily today on the technology curve. Frankly, Rick can invent it and we can use it.
You can perfect it. Yeah, we at Common Fund see the next arc of growth coming from impact on services, right? We're heavy investors in the infrastructure layer. We've seen the killer apps get developed, and then next will be services.
Yeah, we was in Lingora in legal. You think about all the professional services and whether they're end user or, as you said, owning the customer, but then completely changing the back end. That we think in the legal profession, just given the nature of that business being very rules based, very structured, perfect for AI disruption, that you talk to the major law firms, and sadly, I guess some of them are here, that probably half of those back-end lawyers might not need to exist, and therefore you're going to see incredible compressions in number of lawyers, but then great value for our companies as they're able to push back on their vendors.
Great. We'd like to open it up to the audience for questions. Please let us know if you have a question. Put your hand up. We've got some microphones around the room. Got one here.
Oh, sorry.
Hi, Brian Nagel. So I'll ask this a kind of big open-ended question, but as you're all talking about AI and the companies you're investing in, how they're driving AI, what do you view as as we're thinking about this rapid growth, this rapid adoption broadly across the U.S. economy, frankly, the global economy? What's the most likely speed bump that could happen here in the near term? Where could this get? I don't want to say derailed, but damaged here in the near term.
It's going to be incredibly choppy, and whether you think about the employment aspect of it or adoption aspect of it, Torsten's chart up there, which I think is interesting because it looks backward and not forward, of AI having very little impact in so far. If there's something that happens that companies say, hey, I'm not seeing a real ROI on AI, and the opposite of what's been happening over the last 18 months when companies announce they're adopting AI, they're slimming down their workforce and they get a benefit, or actually, as scary and harkening back to the internet era, we're spending more. If you're a hyperscaler, if you're Meta and you're Google and you say, oh, we're doubling our AI spend, the stock goes up 5-10%, which is hundreds of billions of dollars in their case. If that sentiment changes because you don't believe you're getting juice out of it, and Meta says, hey, I'm cutting my AI spend 50%, and that goes down, it creates a huge cascading effect that both in the credit markets, especially private credit, these deals are very circular, very highly leveraged, and very long arc, right? Part of the reason we don't like these capital-intensive projects is you're putting money in the ground to see an ROI in 5 years. And if your customer, largely, I think about 60% of the customers of everything from chips to bandwidth to energy are 5 companies, and they're the hyperscalers. And they have tremendous market power. And if you're Meta and you say, I don't need half those data centers that I gave you a fuzzy PO for 2 years ago, it then creates the cascading effect of therefore what happens to everything from GPU to electricity, and it creates that huge air pocket. I think we're going to fill up into it, no different than the dark fiber from the early 2000s, where it was called dark fiber because it hadn't been lit up yet to create bandwidth. And some of that fiber remained dark for 3 to 5 years, and Y Cable and Wireless or Global Crossing and some of those companies went bankrupt during that time. But that creates the air pocket where where you're going to see some of the car wrecks and anything else. Not dissimilar. If you're a student of history of railroads, were people going to get in railroads? Yes. Did all the railroads go bankrupt about 110 years ago? Also yes, because it's really hard to match long-term capital-intensive projects with current short-term customer consumption.
Any other speed bumps you see coming, Todd or Mario?
The models in healthcare. Clinical data is very complex. It's inherent in the electronic medical record. It's in physician notes. It's in all kinds of nuanced areas, lab reports, et cetera. Training the models is really the moat. If you don't train the model right, adoption is slow. And then also thinking that you can take the human out of the loop, or I call it just to get our buyers not pissed off. I say human at the helm. You can't do that. Doctors are going to still have to make the final call. Now, as I said, a doctor being able to sign off on 1,000 images in a day rather than going through them manually and picking 100 is going to increase productivity, but getting too fast ahead of ourselves, think we're going to automate closed loop systems, and training these moats and these models is absolutely key.
Question here, Michelle.
Hi, good morning, everybody. Happy to be here. My name is Michelle Chowtai. I'm with Fairview Capital. I just want to double down a little bit on that question on speed bumps. So we're talking about AI becoming more efficient. We're talking about consumers maybe demanding less costs for whatever they're consuming. And so that may lead to less revenues. How do you think the impact of that is going to impact companies?
I'll take it. I think it's a velocity question, actually. So as revenues might come down, Michelle, I think you'll see more consumption. So it depends. If we're talking consumer goods, we can only drink so many sodas in a day. So I think that's different. But if we think services, this velocity of consumption of services, I think is going to increase, and that because it's going to make people more able to do that. What I've noticed in my career, I'm sure others have seen this, just the speed of opportunity flow has wildly increased. It used to be you work on one opportunity a week, like intensely. Now it's 3, 4, 5. I get text, if there's a lawyer in the room, I do not get text messages, but I get text messages, calls, emails on the same opportunity back to back to back. That velocity has changed just with basic IT infrastructure kind of communications. I think AI is going to reduce certain prices, increase others, but on the ones where it reduces, it will drive just greater velocity or consumption of goods.
I just think it pushes out the efficient frontier, no different than, like historical analogies like airlines, right? So airlines used to be very, very expensive, very non-approachable for most people. As you were able to get more efficient in airlines, you were able to push out that efficient frontier. Price of airlines dropped, made it more accessible, more people fly, travel's good. Now you need more access to different types of lodging, things like Airbnb emerge. So, if you think about, again, and maybe to extend historical analogies, the Industrial Revolution in the 20th century of America, if you think about all the different opportunities that were created by kind of that Industrial Revolution, most of them we don't know now. Most of them that are going to exist in 20 to 50 years, we can't even imagine, which is what makes our jobs fun. But you're going to see great opportunities for both consumers, both from a consumption perspective, but also professionally.
The only other thing we didn't talk about on this panel is where the markets are all headed, and I just wanted to add one comment, which is to say that I believe the secondary market and private equity and venture capital will continue to grow. It's happened in other markets. If you look at real estate and you look at fixed income, equities, et cetera, we'll see a lot more spend in secondaries to buy up interests in companies like this, whether it be a specific business that you know a lot about because you're a sector expert, or you're buying tail-end portfolios from large institutional investors who are going to want to churn very long-dated portfolios. So I'd say that's the other mega trend that we're seeing.
Well, the best companies are using it as a incentive for their employees to cash out a little bit of their equity, and that's been some of our best companies doing that, like doing a secondary every year, and employees get to cash out a little bit, so it's a huge incentive factor.
I think we have to end it there in the interest of time, but appreciate everyone's attendance here and
Thank you.
input.